So today we want to talk about option pricing, but before we get into that, a quick disclaimer: TLDR version is don't trade based on what you are hearing today or what you see in the deck. It's not an investment advice, not a financial consultant, nor a tax advice. You are responsible for your decisions, so be careful. All right, I don't see new names here, so I'll skip the regular intro here. Let's jump right on to for our session topic. So quick recap, what have we covered till now? We started with very basics of option contract, looked at the building blocks, talked about two basic strategies. Then we looked into what's the money nest state of an option contract, what are the different money nest states, then how the whole option exercise assignment process works. And then we looked, the previous session, we talked about if you're trying to open a new trade, because now based on all what we have learned till now, people would start to go and start adding trades. So we look through the checklist that you should run through. Maybe put a post-it on your laptop, computer, trading terminal before you open a trade. And slowly, that will become your muscle memory. Then you can tear up the checklist. And lastly, we also talked about if you have a smaller value account, what are the different option trading strategies that are available. Things like Tesla is now $1,500. Amazon is $3,200. How do we trade that? That's huge ticker value. And one contract, let's say in Amazon, would mean the 310K. So how do we trade those things? We talked about in our previous session, looked at various strategies around that. So now let's start going a little deeper than by just dipping our toes. Let's start to understand some of the innards of option trading. So first thing that I want to talk about is option pricing. So that's the plan for today. We're going to look at option pricing. So now the whole objective is not to, that we are not here to calculate the theoretical pricing to figure out whether the option is priced perfectly or not. That's not the objective here. What I want to talk about today are the two basic components of option pricing. Then later on we can dig deeper into how option prices are calculated. But because we're not going to determine the option pricing, that I will leave it for market makers in terms of what option pricing they put forth, and that's what we see in our trading terminals. We are not market makers, we are market takers. So for me, whatever I see on the option terminal or on my trading platform is the pricing for me. Even if that pricing doesn't directly fit into the option formula, I don't care. That doesn't matter. If you have to trade, we have to trade with what's available for us in the market. So, but today I want to just give a quick overview of, what at high level, what are the components of option pricing. Then in subsequent sessions, we will determine, dig deeper into how those are being impacted and things like that. And lastly, then we'll open it for Q&A. What we're going to discuss is, what are the factors that impact the pricing of options, but we're not going to talk about the option Greeks, but I will just kind of introduce the Greeks. Greeks is another different, a big topic in itself, and that I will cover in some, later sections. But today, at a high level, we just want to understand what's the breakup of an option pricing, and then what are the factors that would impact. Then then comes in terms of if you want to understand how the option pricing will change, where you should be looking at. That is Greeks. All right, so let's continue. First, why are we talking about this? Because option prices do not stay constant throughout the expiration cycle. So if you have sold an option, you would see the option pricing will increase. You know, if you have sold a put and the stock goes higher, your option price will decrease. If you have bought a put, stock goes lower, that option price will increase. So it does not stay constant throughout the expiration cycle. Even if stock doesn't move, there are a lot of other factors that impact option pricing. Now, to know how the option pricing will change and impact your positions, your trades, it is important to understand what are the factors that impact it. You know, in case of a stock, you only have to worry about what you see in your screens, right? That is your current price. But that's it. If you have bought a stock, the only way your portfolio will be impacted is the current price the stock will change. You know, that's the only impact. If a stock price moves in your favor, your portfolio is green. If it moves against you, it is red. The color red. I don't like that, but we all have seen those things in our portfolio. If you're only holding stocks, then the current market price is the only thing that you need to worry about. But if you're holding options, there are more things that will impact the option price. And we have seen cases like even if your underlying stock price moves in the direction that you want it to, your option trade still may lose value. For example, say you were bullish in Tesla, and you know this happened in the previous, just the earnings cycle, and Tesla was trading at $1,500, $1,700, and if you had bought a call of Tesla at $2,500, at $3,000, after earnings, stock moved up, but your option trade would have still lost value. And that caught many people by surprise on what happened. I thought if I bought a call option and if a stock goes higher, my call option should become profitable. But that wasn't the case. So if you have just bought the stock and the stock price goes high, it will be profitable, but in case of an option, that may not always be the case. So conversely, it could happen that the stock could go against your direction, but the trade could still come out to be profitable. So there are factors which impact the pricing of the option other than the stock price. Of course, stock price is one of the factors, but there are other factors that impact the price of options. And those are the other factors where most of the retail investors, they get caught and wonder what happened. So let's look at all those factors that impact the option pricing. Right? A quick recap on what's an option. I don't think I have to do that recap over here. Most of you have already seen all the familiar names, and most of you answered the quiz rightly, so we don't have to go over it. All right, so let's look at the option pricing. Before we jump into the factors, at a high level, it is important to understand that option pricing can be broken into two components. One is intrinsic value. The other portion is extrinsic value. The reason I'm talking about these two terms is later in the session, I will tie it back to the previous, to one section of assignment risk, which I had skipped when we talked about option assignment exercise process. At that time, I had mentioned I will cover this topic when we talk about option pricing. So that's why I'll tie it back to it. And these terms are used extensively in discussion in industry or on your broker platform. So what is an intrinsic value? Intrinsic value is what the innate value, which is just the difference between the stock and the strike price. So in extrinsic is everything else. Again, I'll repeat. Intrinsic value is calculated by the relationship between the stock price and strike price. Everything else portion of your option pricing is called extrinsic value, or the other term is time value. So let's understand what's the difference. Like I said, intrinsic is innate value. It's, whatever that option pricing is worth because of the strike price and the stock price. Everything else is extrinsic or time value. For example, imagine this is the last moment of expiration cycle. You're on Friday, it is, if you're in PST time zone, it is 12:59 seconds. Or for folks joining from East Coast, it is 3:59 seconds PM. This is the last moment of expiration cycle. If I were to exercise my option right now, how much money will it make for me? This is the intrinsic value, because there is nothing else left. You're at the last moment. At that point, there is nothing else left in this option, because a second later, this option will expire. So the intrinsic value will tell you how much money is this going to make for me if this is the end of expiration cycle. For example, this is a call option example in which the stock is currently trading at $110. Okay. That's where the stock is currently trading. Now I am buying a call at a strike price of $100. I'm not suggesting that anyone should buy it, but let's understand the whole concept of intrinsic and extrinsic. So stock is at 100. I have bought a call option at a strike price of 100. Sorry, stock is 110. Strike price of the call option is 100. But you will not get it at, $10. You will have to pay $13.65. In this case, the intrinsic value will be $10 and the extrinsic value will be $3.65. So the reason is, let me explain it. If you have bought a call option at $100, so you bought a call option at 100, which gives you a right to sell stock, to buy the stock. You bought a call option, so it gives you a right to buy the stock at 100. Now, if you're at expiration, if you buy the stock at 100 and the stock is currently trading in market at $10, what is the worth? How much profit will this make? It will make you profit of $10. because this call, long call, gives you a right to buy the stock at 100. And in the market, the stock is trading at 110. So just by exercising this call, you can get the stock at 100, sell it in the market at 110. You can make $10 of profit. So the $10 is inherent or innate value of this call option. So this is the intrinsic value in this call option. But if the world was so simple, everyone will do it. This is not a free lunch. When you're buying this call option, you are paying $13.65. So you can't just buy the call option and exercise it, get the stock at 100, sell it at 110. No, because you will be paying $13.65. You have paid $3.65 extra. This is your extrinsic value. Right? If this call option is available at $10 or less than $10, everybody will do it. Right? So that's not how it works. You have to pay more than $10. So whatever you pay more than $10 is your extrinsic value. Okay. I hope this makes sense. If there is any question, do let me know. Now, this is important to understand. Quickly, if you were to look at what's the intrinsic or extrinsic, this is how you can quickly look at is if this is the last day of expiration, how much money is this call option going to make? It's going to make $10 for you. So $10 is intrinsic, remaining is extrinsic. Right? All right, let's move on. Take another example. Stock is trading at 55. Now I bought a call option at a strike price of 56. And I had to buy that call option at $1.65. What is an intrinsic value? Anyone? How much money is this call option going to make for you if the stock is trading at 55? So this is a little trick question, but the real answer is the intrinsic value in this case is 0. All the value that you have here is extrinsic value. All right, let me make it clear why it is. So call at a strike price of 56 allows you to buy a share at $56. In the market, the share is trading at 55. This call is worthless for you. Why would I exercise this call to buy the shares at 56 when I can buy directly from market at 55? This call option is not doing anything for me. This is worthless. So its inherent value is 0. So everything this is extrinsic. Now a quick way to look at and understand this is any option that is out, any OTM option has got 0 intrinsic value. Only thing that they have is extrinsic. Now go back and remember the whole session on moneyness. That's why I covered it before this, where we've determined how the how to determine and understand whether it's OTM or it is in the money or the strike option is at the money. So if it is out of money, it has got zero intrinsic value. Whatever premium that you are paying for extrinsic time premium. Some people say, you know, why I'm paying for fluff. You're paying for pixie dust, call whatever you may want to, but there is no inherent value in this call. Because stock is at 55, you will never exercise to buy a stock at 53. So the whole $1.65 is an extrinsic premium that we're paying. Okay, the next one. Stock is trading at 58. Call at a strike price of 59 is trading at $1.25. What is the intrinsic value and what is the extrinsic value? All right, let me just, give me some answers. This is similar to what we had talked about. The intrinsic is 0 and the extrinsic is $1.25. Exactly. Because this is out of money, no one would exercise this call to buy the stock at 59 when in the market they can get it for 58. Next one. Call option. Stock is trading at 88. At a strike price of 85, you are paying $3.65. What is the intrinsic value? And what is extrinsic? Right, most of you got it right. Intrinsic is $3 because that's what this call option allows you to profit immediately on expiration. You can buy it at 85, sell in the market at 88. The difference is your intrinsic value. Whatever remaining is your extrinsic value. So $3 is intrinsic, 65 cents is extrinsic. So for a call option, we have seen that your strike price, if it is greater than your spot price means or the current stock price, what is the current market price of your stock? If the strike price is greater than the stock price, then the intrinsic value is 0, because in that case your call option is out of money. That's why the intrinsic value is 0. But if the strike price is less than the stock's market price or the stock price, then the intrinsic value is the difference between the stock price and the strike price. Make sense? So those are all the examples we looked at. If you're buying a call option at $50 strike price and the stock is trading at 55, the intrinsic value will be 55 minus 50, which is $5, because the strike price is less than the spot price or the stock price. Let's look at how it happens for a put option. So let's say for a put option, stock is trading at 70. You bought a put at a strike price of 72, which is trading at $3.65. What is the intrinsic value? Again, we have to apply the same thought process, saying I am at an end of expiration period. A strike price, this put option what that allows me to do is to sell the stock at 72. In the market, the stock can be sold at 70. But because I had this put option, I can actually sell it at 72. So holding this put option, the inherent value, the innate value of this put options is $2. Because if I didn't have this put option, I cannot sell the stock at 72. I will be able to sell it only at 70 because that's what the market is willing to give. But because of this put option, I'll be able to sell it at $2 higher. So $2 is the intrinsic value of this contract. Whatever is remaining becomes the extrinsic value, which is $1.65. Let's do some other quick examples to look at different points. Stock is trading at 58. Your put is at a strike price of 55, and that is trading at $1.65. What's the intrinsic value? And what's the extrinsic value? So this put option, if you bought this put option, it will allow you to put the stock or to sell the stock at 55. In the market, current market price of the stock is at 58. So how much is an advantage do you have because you hold this put option? Here, Raghu got it right. So the intrinsic value is 0. Why would I ever exercise to sell a stock at 55? I would directly sell in the market at 58. This put option is not giving me any advantage over what market is giving me. So if I hold this XYZ stock, I bought a put at 55 to protect myself in case the stock goes below 55. Stock hasn't gone below 55. So if I were to sell the stock, I would sell it at a market price. I will never use this put. This put is worthless for me. So this has got 0 intrinsic value. Everything that we are paying to buy this put is the extrinsic value. Right. Next one. Stock is trading at 75. And you got a put at a strike price of 72. That is trading at $3.65. How much is the intrinsic value and how much is the extrinsic value? And if you're wondering why these exercises here, this is a boot camp. In a boot camp, if you attend, and I can only talk about the technology business. If you attend a coding boot camp, you got a code. You don't just hear and learn about the syntax or how the structure of code. You gotta do real code. So here you gotta solve the problems. Otherwise, I would just say it's a lecture. No, this is a boot camp. Your intrinsic is 0, yes, and extrinsic is $3.65. If a stock is at 75, no person in the right mind would exercise a put which will give them a right to sell it at 72. I would rather sell it at 75 in the market. So everything that we are paying to buy this put option is extrinsic value. Next one. Practice makes a person perfect. So you got to practice some of these questions. Stock is trading at 56. You buy a put at a strike price of 60. Oh, that's a wrong question in itself, because you will never get it by $2.85. So no market maker will do it. It should have been 585. Okay, there was a typo. Okay, I need to fix it maybe later on. So uh, anyway, I revealed the answer. So yes, if it is selling for 585, $4 is intrinsic and $1.85 is extrinsic. Let me take a note of that slide. Okay. Let's snake the chain. All right. Yeah, if we find such a trade, I'll be all over it. In that case, I might just forego my position sizing guideline. Just kidding, we'll never be able to find that. So as we have seen, in case of put options, it's the reverse. The intrinsic value is equal to the stock price minus strike price. If you're, okay, probably I didn't have enough caffeine. It will be your strike price minus stock price. And in case your strike price is less than the spot price, then the intrinsic value is 0. So again, I want to make sure that to make it clear, this is not here. It's intrinsic value strike price minus spot price or the stock price. Because strike price is higher than the spot price, so the intrinsic value will be the difference between these two. And if it is less, then the intrinsic value is 0. Because in the market, I can sell it for a higher price, then why would I ever exercise to sell it at my strike price? So the intrinsic value is 0 in that case. For call options, it was the reverse. So that's how all about, the two major components of any stock option pricing: intrinsic and extrinsic. Now, as we have seen, the intrinsic is derived by the relationship or the difference between the strike price and the spot price. Everything else, the time value, the helium value in that option, the fluff in that option, is derived using other components, which is days to expiration. How much time is left before this option expires? Is it a monthly option? Is it monthly? When I mean to say, means is it like 30 days away? Or is it expiring in a week? Or is it expiring in 9 months, 10 months? Is it a leap option? If you pick the same strike price and the market and you pick up different expiration period, consider everything else remains same, the option pricing will be different because your time value will be different. The other factor that impact the time value is volatility. Is the option expiring next week? Does that have higher volatility than the option expiring 4 weeks later? If it is, then there will be a difference in the extrinsic value and hence the difference in the option pricing. As long as the strike price that we select is the same, your intrinsic value remains the same for all the option contracts, right? Across, I would say, different expiration period or different volatility. But if your Yeah, if your strike price, if you select that's the same, then the reason why your option pricing changes is because the time value in that keeps on changing. The third factor that impacts the time value, and this does not play too much role in, mostly uh, at a time period where I trade, is your rate of interest. What is the rate of interest, risk-free rate of interest available in the market? Now, most of the time, my sweet spot for doing option trade is between 30 to 60 days out. That's when 95% of the trades will fall in. In that case, generally interest rates don't change. Fed has already told that they're gonna keep the interest rate to where it is till 2022. So don't worry, I don't worry much about the rate of interest. Things that I worry about is the volatility, time to maturity, when I'm looking at an extrinsic value. Now, if these are the components of option pricing, how do I know, how can I keep track of how my, pricing will change? What are the indicators that we have available which will tell us how the pricing would change? So those are called option Greeks. Option Greeks, once we start digging a little deeper into options, there are 5 types of Greeks: delta, gamma, theta, vega, and rho. And each one of these Greeks tell us how the option pricing will change depending upon what's happening to stock price. Because if a stock price changes, your intrinsic value will change. Or what's happening to time to maturity. If you wait for one more day, you're getting one more day closer to expiration. A week later, you will be 7 days closer to expiration. So your extrinsic component would change. And how would you know, how that would impact? In 7 days, how much of this option will lose value? The theta can tell you that. Vega will tell you about the volatility, and rho will tell you about the impact of rate of interest. So when it's a volatility, Vega will tell you if your volatility could increase by 1%, how much this option pricing will change. So takeaways, our option prices are variable. They're not constant. You buy an option or you sell an option, it will change the moment you have executed your transaction. The very next moment, the pricing could be different. There are 2 high-level components, intrinsic and extrinsic. Now, at expiration, the extrinsic value is 0. Because extrinsic is time value, there is no time left. So your extrinsic value becomes 0. There is nothing else in the world that could impact the extrinsic component of that option contract, because that contract is no longer valid after that. Now, option Greeks will tell us how the option prices will change. If the volatility will change, how much will your option price will change? You need to look at Vega. Assuming tomorrow nothing else happens, your stock stays where it is, there is no change in volatility, what happened to your options that you bought or sold tomorrow? Because they moved 1 day closer to expiration. Theta will tell you that. So that was a quick primer on the option pricing and the 2 big components of option price. We will dig deeper into gamma, theta, and the option Greeks in our subsequent sessions. But let me now open up a trading platform and show you, how you can get these values. And the most important ones are deltas and extrinsic. So let's look at how can you find this extrinsic value? Do you always have to calculate? No way. Your trading platform should tell you at minimum what's the extrinsic value. And then if you know the extrinsic value and you know what's the current price or current option pricing, immediately you can figure out what the intrinsic value is. So let me jump on to the trading platform and look at the extrinsic value. So here's a quick example. This is SPY. And we're going to look at the intrinsic and extrinsic values of various options. Currently, I've selected 18 September as an expiration period. So right hand side, we have puts. Left hand side, we have calls. Here is extrinsic. Remaining is intrinsic. This column will tell you what's the extrinsic value of the option pricing. So now let's go back to what we talked about. If you have a put option, first we talked about the call option, right? So let's take in the same sequence. For a call option, if the strike price is higher than the stock price, so today the stock price is at 337.44. Let's assume it is at 337. So for every option contract where your strike price is higher than the stock price, your intrinsic value is 0. Why would I call or give myself, why would I exercise an option which gives me a right to buy the stock at 339 or 343 or 346 when I can buy it at 337? So that call option, intrinsic value is 0. Whatever we are paying for it is the extrinsic value. Everything that we pay for it is extrinsic. On the put side, it's the reverse. Everything that is below the current stock price, why would I ever exercise this put if I am not drunk, if I'm in right senses? But this put, if I buy any of these put contracts, it allows me to put the share at 330. I would rather sell it in the market at 337. That is why there is no inherent value, no intrinsic value in these put contracts. If I am buying, let's say $330 put option, I am paying between these two, let's say $590. That $590 is completely the extrinsic premium. This is what we call it as time value or air or flow. So open up your trading platforms and you should be able to see extrinsic value. And it is important that you should be able to see this, because next we're going to talk about how this will help you to avoid some of the surprises on assignments. So if your trading platform does not show you the extrinsic value, call their help desk and understand how you can find the extrinsic value. Or otherwise, maybe you switch your trading platform to some other which is actually made for option traders. Without knowing the extrinsic value, we kind of a half blinded when we're, especially when we are selling option. If you're buying an option, you know what you can lose, what's your maximum loss, and there are no surprises for assignment, etc. Because hey, you own the right, so you choose to exercise. Nobody can assign that to you. But because we're selling option, we are at a risk of assignment. Today, pop quiz question number 1. Who is at a risk of assignment? It's an option seller. And extrinsic value will play a huge role for us to understand if I'm at risk of assignment or not. So your trading platform should show you the extrinsic value. Dave, okay, I think interest is equal to rho. Yes, Dave, I think already covered. Oh, Deepak already answered that. Thank you, Deepak. What do you look in the monitor tab? The account activity with Greece or the account statement? So for example, right now, if I'm looking at the trades tab, and I know where I have sold that option, and I know what's the extrinsic value in that option. So if I were to find that out, I will look at the trade tab. If I were to find out an extrinsic value at a particular strike price, say I had sold an option at 330, then I will look at an extrinsic at 330. So I mean, if you look at your portfolio, overall portfolio, then I am more looking at delta. I can get it at the analyze tab. But that's what I'm more concerned about. What's my delta of my portfolio? I don't know, or probably I haven't looked at overall portfolio level extrinsic value. That I haven't yet tried to look at in Think or Save. I don't know if they even provide that. So might be a question for me to go and ask people, if I were to look at extrinsic premium at portfolio level, where should I go and look at it? I don't know if it's on the monitor tab. Does it provide here? This is a simulated trade. I don't know if I can pull it an extrinsic value. Oh, I can. So let's see. But these are, I think, I don't know when I last logged into this one. So maybe in my real account, I would try to look into the extrinsic, and then probably I can look at all the, then if it extrinsic available, then I can look at all the Greeks over here. That's just that when I'm managing the trade, I manage the trade at an individual level, but I keep a good eye on the delta and time. Also, I do have a delta selected here and a vega selected here, but I never looked at an extrinsic one. All right, so it may be for a stock and not PDF. Or no, you will be able to find all the Greeks for the stock as well as the ETF. Okay, so let's jump into the second section, which is, this is something which I had left earlier when we talked about the whole assignment process. I skipped this particular section then because that time we had not talked about the extrinsic or intrinsic value of option. So now we can jump into this. So if we are sold a call option, how do you find out what's the assignment risk? Let's recap. If I'm selling an option, I am at a risk of assignment anytime during the option expiration period. Right? If I sold an option today, which is expiring in 2 months, I could get assigned tomorrow. Though the probability is very, very less, but in theory it is possible. Someone desperately wants the shares, could go ahead and exercise their long call option, and randomly it could come over to me for assignment. So how do we find out, is my short call is at risk of assignment or not? So let's look at, let's skip all that. So when I say short call, it means you have a short call on in your portfolio on a ticker. Either it's a naked short call, you sold a naked call, which if you are just beginner option trader, I said, don't do it. But you could still do a call spread, that vertical spread. You could have sold a call and you would have bought another call at a higher strike price. But in both the cases, you do have a trade, a leg, which is short call. Now, by having that leg in your portfolio, you have given someone else the right to call the shares from you, whether you hold the shares or not. If you hold the shares and then you sell a call, that's called covered call. If you don't hold the shares, then you sell a call, which I recommend don't do it, it's called naked call. But because you have sold a call, you have given someone else a right to call the shares from you. So how do we know when those shares may be called from you? That happens through a process of assignment. And generally, assignment will happen if the option is in the money. Means, if we go back to our moneyness of option contract, when we say it's in the money, means it is making money for the option buyer. So as an option seller, I am at risk of assignment, because if it is making money, only then someone would choose to exercise it. Whoever has bought an option will choose to exercise only if it is making money for them. Second criteria is the option is very closer to expiration. Most of the time, I have seen that most of the assignments will happen in the last week of expiration period. Again, this is not a firm blanket statement. Generally, or mostly, the assignments will happen in the last week of expiration period. The reason is the extrinsic value. But sometimes you could get surprises. There are some exceptional circumstances in which you can be assigned way earlier. And those are if there is a dividend coming up. And this is one area where, if you are just new to option trading, you could be caught surprised when you get up in the morning and then say you already have an email saying you've been assigned this call option. And you're like, what? This is still a few weeks away from expiration. It is because there's a dividend that's coming up. And why, if a dividend is coming up, why would your call option, this call option that you sold, could be at risk of assignment? Is because whoever has bought the call option would want to own the shares so that they can get a dividend. Excuse me, I'll just sip some water. Remember, option holders don't get any dividend. If we're holding a long call option, even though that's a bullish equivalent to holding stock, you won't get dividend. Only the shareholders will get the dividend. So if I want to get dividend, then I want to make sure that I have shares in my name on the dividend record date. So that is one area that if a stock or an ETF has a dividend coming up, let's say next week, even though the call option expires in September 18, this could be at a risk of assignment. And it's not that it always is. We will look into how to find out if it is a risk of assignment or not. But all I'm telling you right now is if there's a dividend coming up, there is a potential that your call option may be assigned much sooner than what you would have been anticipating. When I say early assign could be to pay for margin call by the broker. Yeah, it could be any reason. You know, if a broker, if I have a short stock and I need to close that position and have a long call, I might just, exercise my call. Chris, can you talk about how an can affect the price to say a put option, sold a put option dividend values included or no? Okay. So when a put option, when you're selling it, so all the dividends, etc., the pricing does include that there is dividend coming up. So Chris, now whether if you have an option, will that option be at a risk of assignment or not? That's something which we can talk about. But the option pricing does include your, if there is dividend coming up, let's say in 2 weeks, and you are selling or buying a put option for September, your option pricing will account for the dividend. But whether it will be at a risk of assignment or not, that's something that we're going to talk about. So one reason is exceptional one reason why your call option that you sold could be assigned way sooner is upcoming dividend. Another is your strike price or your trade is deep in the money. Right, so let's switch back. When I say deep in the money, means if I have sold a call option, if I've sold a call option on SPY and I sold the call option on, let's say, 280, and today the S&P is at 337. This is way deep in the money. So this, if I have this call, this could be at a risk of assignment. Even there are 18, if there are 37 days left for expiration, well, this could be a candidate for risk of assignment sooner. But if I had sold a call option at 320, this probably is not at a risk of assignment because this is not deep in the money. So 2 reasons. One is if there could be a dividend coming up, or if your trade is already deep in the money. Now let's look at what's the assignment risk due to the dividend. There are different ways in which we can find out if I have sold a call option. If you have sold a put option, it does not have any risk of early assignment due to dividend, because put option gives the buyer of the option to sell the shares, not to buy the shares. So there's no early assignment risk if you have sold a put option. The early assignment risk happens only if you have sold a call option, because then someone else will want to call the shares because they want to get the dividend. So there are ways to check it. First thing is extrinsic value left. how much is the extrinsic value which is left in my short call trade. For example, if I had sold a call option at say 320, I want to know how much is the extrinsic value left. Is $3.43. Compare that with if I sold a call option at 270. How much is extrinsic value left? Say 44 cents. One way to figure out, the first step to figure out if your call option, short call option, is at a risk of assignment because of an upcoming dividend is, number one, it is in the money. Number two, step number two, what's the extrinsic value? Now, once you've found out what the extrinsic value is, then you compare it with what's the expected dividend. How much dividend is being proposed? Or historically, we can go to NASDAQ or Yahoo Finance. We can look at what's generally the dividend that's was given out last quarter. Or if it is a monthly, you look at what was the amount of a dividend. For put options, there is a risk of early assignment, not for dividend. So put option, so right now we're talking about early assignment due to dividend risk. There would not be early assignment due to dividend risk. There could be early assignment when we talk about the other factor, which is deep in the money. Yes, sorry, there are other reasons. If it is deep in the money, then yes, but not because of dividend. So if the dividend, coming back to our short call, if the dividend that is being proposed is greater than the extrinsic value left in the short call trade, then your short call option is at risk of assignment. Say S&P 500. I don't know how much dividend the S&P gives. Anyone? By dividend history. So SPY gives a dividend, quarterly dividend of, let's say, $1.40, 45, right? It's been around this range, 45, 50. Let's say it's a dollar 45. Is their quarterly dividend. So now, if we are at $1.45, and if I had sold 274 call option, this is at a risk of assignment. This is definitely at a risk of assignment. 99.9% will be assigned. But if you have sold a call option of 308, that is not at a risk of assignment because the extrinsic value is more than dividend. Now let's understand why this is. So whoever is a long call buyer, if they choose to exercise their 308 strike call option, they are immediately foregoing the extrinsic value. It is as if its expiration is right. The extrinsic value, they are to forego the extrinsic value. Why would anyone in the right mind would give away $2.13 of extrinsic value to capture $1.45 in dividend? Just doesn't make sense. So that's the reason why, if the extrinsic value left in your short call is greater than the amount of dividend being proposed, you are not at a risk of assignment. But if it at less than the amount of dividend, then it's a no-brainer for me. I will, if I'm a long call holder at a 285 strike price, I will exercise this. I'll get the stock at 285. I'll get a dividend of $1.45. But because I exercised it, I've lost that 81 cents. I had to forego. That's okay. I still made 60 cents or 64 cents. So this is at a high risk of assignment. So that is why it is important, if you have sold a call option, to know what's the extrinsic value if there is a dividend coming out. And your broker, I know at least TD Ameritrade, and I think Hasty Works also, but broker will send you an email, or broker should send you an email saying there is an upcoming dividend, you may be at a risk of assignment. They are not going to do the calculation for you to figure out if it is at a risk of assignment or not. And I have gotten, some ping on Slack saying, I received this email. How do I know whether it is a risk of assignment? This is how you know. Your broker will just tell you you have an option, you have a short call option in which a dividend is coming up. It may be at risk of assignment. This is how you find out if it is at risk of assignment or not. Check the amount of dividend. Check the extrinsic value left in your short call option. If the dividend is higher, then you are definitely at a risk of assignment. If a dividend is lower, then you are not at a risk of assignment. Okay. Let me see if any question, but this is important. That is why knowing the extrinsic value of your short call option is important, so that you're not surprised. So if I had sold 285 call option, then I know come tomorrow, I will have a short stop. The shares will be called away from me. Now I can take an action having this information. Do I want to close my short call position, or am I okay to let the shares go, etc., etc. But this will avoid the surprise, which I would have otherwise gotten. Morning when I said, what happened to my shares? That was called away. Why? Because there was a dividend coming out. And the dividend was higher than the extrinsic price. My shares got called away. Let me see if there are any questions. Looks like if my short put is at 95% profit, why not wait till the end to got all the premium you can get? Be a pig at the risk of getting killed, not so. Yeah, this is a different topic, but yes, I won't wait. If I'm at 95%, I would close it even sooner than that. My profit targets are a little different. Because to capture 95%, you have to go much closer to expiration. You enter into a lot of gamma risk and all the other stuff. So I would rather close it sooner, not exposed it to gamma risk, and recycle the capital. All right, so this is how you find out what's the extrinsic value remaining and whether your short call is at risk of assignment or not. Second way to check this. Say if your broker platform does not provide you the extrinsic value, you go ahead and find out what's the value of the corresponding put option at the same strike price. Let's jump back into the broker platform. It doesn't apply here because here I can find out the extrinsic value right up front on Think or Swim. But just that if you have a broker platform that does not give you extrinsic value, if I have sold a call option at 285, what you could do is to come to the put side and find out what's the amount of value left in that put option. It's $1. Generally, these will be closer to each other. There are differences like we are seeing it now, but if you get little closer to where the stock is, not so deep in the money. This is another way to find out. If you don't have this, everyone will, have the amount of what the put option is trading at, right? In this case, put option is trading at close to $1. If the dividend is 4.45, this is at risk of assignment. So if your broker platform does not have extrinsic value, look at the corresponding put option. If I had sold if I'd sold a 320 put option, a call option, I will come back and look at what's the corresponding put trading at, let's say 385 in this case. This is not at a risk of assignment, because this is higher than the amount of dividend. So this is not at a risk of assignment. So that's another way to look at how your put option is at a risk of assignment, or your call option is at a risk of assignment or not. Now the reason why this put option, I just want to share a thought process of why we look at a put option, and we can still figure out whether it's at a risk of assignment or not. What I will do, my writing. Okay, so let's understand, the logic behind it so that it's clear why this put option makes sense. Say if I'm a long call holder, only a long call holder can call an option. That means if you're a short call seller, you will be at assignment. You had a risk of assignment. If I'm a long call holder, my profit and loss diagram, let's say this is 0. This is the strike price. My profit and loss diagram looks like this, right? If a stock goes above my strike price, that's all is profit. Maximum loss is limited to the amount of premium that I paid, right? Now there is a dividend coming up. I want to capture the dividend. That's my sole purpose. But I don't want to take any additional risk to my position, because then, that will completely upset my P&L or my portfolio position. My sole purpose when dividend is coming up to capture the dividend and make sure I don't have any additional risk here. So to capture the dividend, what I need to do, I need to have the stock in my portfolio. And that's why as a long call holder, I would exercise the stock. So say this is 0. If you have a stock in your portfolio, what's the profit and loss diagram? So this was a strike price. I bought, or I exercised my long call at this strike price, means I got the stock at this strike price. Now if a stock goes higher, I'll make money. Consider it as a straight line. So this is my profit zone. But if a stock goes lower, this is my loss zone. Again, step. To capture dividend, I need to have a stock. First step is I want to capture dividend. I got the stock. But if I get a stock, I expose myself to unlimited losses. When I had long call, my losses were limited. But because I got a stock, I got unlimited losses. What am I going to do? to come back to exactly same risk profile, I will buy a put. But if you buy a put, you give yourself an option to put the stock or to sell the stock at a certain strike price. I will buy a put here and I will cut off my losses, right? So now my profit and loss diagram will look like this. Which is exactly same before. No change in my profit and loss. Because I got the stock, I got the dividend. But additional thing I had to do was to buy a put here. But if I have to pay more to buy the put, then the amount of dividend I'm receiving, then this does not work for me. But if I had to pay $2 to buy this put, dividend was $1.45. So if I have to pay $1 to buy this put and the dividend I receive is $1.45, I will do this because I will exercise it and immediately buy a put. So my risk profile is exactly the same. And I know I'm going to get 45 cents net profit. So that is why you can look at a corresponding put option and find out if your short call could be at a risk of assignment or not. This says corresponding put option is also equivalent to extrinsic premium in your short call option. Look whichever way you can. But if your trading platform does not provide directly the extrinsic value, and that's why I thought I will share. The other way to look at is what's the put selling at, or at what price can you buy the put? If that put can be bought at a price less than the dividend, then you will be at a risk of assignment because long call holder will do these steps to just capture the dividend and benefit without taking any additional risk. Okay. Hopefully this makes sense in terms of why the put option, the value of put option can also tell you whether your short call is at a risk of assignment or not. Chris, which tab shows all the Greeks on this platform? You can look at the trades tab. You can also look at the accounts tab. But if I'm looking at a particular ticker, I will look at the trades tab. So I'll open that up and I'll show it again. So question from, is it true that the amount of money actually at risk is twice the cost of commissions to buy the underlying? I am not sure what it's saying, because if the amount, the risk is that if you have a short call, and again, for my general discussion, and even when I'm trading, I don't really take into account the commissions because the commissions are so low. Number two, commissions vary from broker to broker. So then I cannot talk about things which could be applicable across brokers. So and I don't think any broker now charges even a ticket price, the base charges, which it used to be the case when there was an assignment fee. $15 assignment fee used to be the case when there was a ticket charge or the base charge of $10. Gone are those days. So nowadays I don't worry about commissions. Now, without worrying about commissions, the risk in the short call is if you don't have a stock, then you are a short stock. But if you have a stock, your stock will get called away. So that's the only thing you need to figure out. Do you want to say short stock? Say you didn't have a stock. And again, we are talking about you sold a call spread. So you thought you have a defined risk, right? But you didn't have a stock. And then your shares get called away. Right? Now suddenly you are at a short stock position. Then if you want to close out your position, basically either you have to exercise your long call position, means you have to give away that extrinsic value. So there is some, I would say, mental process you need to go through it. And the idea is, if there is an upcoming dividend, be ready with that. If you figure out that your position is at a risk of assignment. And let's say in my case, some cases, because I sell naked call, I have to think through it. If there is a dividend coming up on let's say Verizon, then I don't want to be short on Verizon, short stock on Verizon. Reason is, maybe overnight, Verizon and T-Mobile, T-Mobile decides to buy a Verizon because they want to be number one. And I'm short stock on Verizon, and overnight, let's say it goes up 30%, I'll be killed. In that case, either I'll close my position or I'll figure something out so that I don't get into this short stock. So the issue is not just that is your strike price multiplied by 100. The issue is, what could be the possibilities if I end up having short stock in my portfolio? Even though at the today's strike price, my portfolio is okay to handle it, what could happen overnight? Nobody knows. So that's a risk which we need to weigh. A question. So I hope, Eric, that helps you, because the actual risk is not the commissions to buy, etc. The risk could be entirely different because things could happen overnight. Chris, don't you have to take into account the sum of call and put premiums to be less than dividend? No. So we looked at the cases wherein if someone is a long call, only those people who are a long call could trigger an event which could lead to an assignment. And they would trigger the event only if the extrinsic value in that long call is less than the dividend, because they will be foregoing that extrinsic value. But if the dividend is higher, then I don't mind foregoing that. The reason why we looked at put is some of the broker platforms, they don't even show extrinsic value. In that case, I was saying, if your broker platform doesn't show extrinsic value, then look at the put option at the same strike price. But to understand whether it's at a risk of assignment, you don't have to add them together. So Chris, I hope that answers your question. Raghu, do you pay commission if you get assigned? Not anymore. When I started TD Ameritrade, used to charge $15, negotiated it to $5, but still, $5 was a big amount. Not anymore. So if your broker is still charging you for assignment, I know Tastyworks still charge it, but I'll still give it to them. No, I don't pay for assignment. I don't pay assignment fee, and neither the commission. There's no option commission being paid, which is anyway 65 cents or 50 cents. Eric says the thinking is you get assigned, you must sell the shares so you pay. No, you get assigned then if you already have a shares, and so you will buy the shares on market significantly. So Eric, are you talking about a covered call or a naked call? So if you have a covered call, then you will have to sell the shares. I mean, your shares will get called out immediately. The moment you get short call assigned, you don't have to do anything. Your shares will automatically go away. And But if you don't have a shares, then you will be short stock. And if your account can hold the short stock, it will stay as a short stock, or your broker will call you or do something. Yeah, commissions are 65 cents per contract. Most of the time, again, this is negotiable. You can call up your broker and negotiate for commissions. There is no P&L even associated with this assignment process. Just at the assignment level, just that whole assignment process, no P&L. But the idea is, second after the assignment happens, the market opens, your position will change if I'm a short stock. Dave, no, I have a commission fee. I don't have an assignment fee. Yeah, the commissions are negotiable. I still have to negotiate it with TD Ameritrade. I pay 50 cents. So if you're on TD Ameritrade, you can call them up and tell them that why are you, why am I paying 65 cents? So I'm paying 50 cents, and I know of people who actually pay 35 cents. I just have to make sure, call them up and try to negotiate again with TD Ameritrade to reduce the commissions. That's the first, one thing I learned. I thought those commissions are set in stone, but no, those are negotiable. So if you should be able to call up your broker and negotiate that. Yeah, but generally everywhere it is 65 cents. All right, so till now we talked about the risk because of an upcoming dividend. The dividend is higher than the extrinsic value left in the short call. It is at high risk of assignment. If your broker platform does not show extrinsic value, fine. Look at a corresponding put option and see how much is that put, can be bought for. This is not the exact calculation, pretty close. Okay. Now let's talk about the other factor wherein it could be at a risk of early assignment, is that it is in the money. It is deep in the money. If you are short call, and this applies even to a short put, if your short trade is deep in the money, means the extrinsic value is closer to zero, then you are at greater risk of assignment. We talked about the reasons. It means anyone who is holding that long option, they will have to forego the extrinsic value if they exercise their option. But if that extrinsic value is close to zero, maybe a couple of pennies, maybe 5 pennies, maybe I don't mind, doing that. I love my stock, so I want to get the stock in my portfolio. If I were to forego 5 cents in extrinsic value, fine. In that case, you could be at a risk of assignment. Generally, it might be, when it is almost penny or 2 pennies left. In that case, you could be at a risk of assignment because it is deep in the money. Either call or the put. So if you have a short put, which is deep in the money, then make sure that you have enough money available in your account to handle that short put, because you could be assigned sooner than when you were expecting. But do you need to panic? In any case, if it's a deep in the money, your portfolio at that point of a time will not change. Things could change later. Because, say if you have a deep in the money put or deep in the money call, based on what's happening to your stock, your position, your overall portfolio is already behaving that it is a short stock, or if it is deep in the money put, that you already have 100 shares of that stock. So portfolio is already behaving as if you are holding a short stock or a short or 100 shares of stock. So from a value perspective, There's not much change. I think Eric wrote, right? There is no big P&L event. Yes. But what could happen later is what you need to worry about. So say you got assigned, or you figure out that you are at a risk of assignment. Now what to do? If you have a naked call, maybe just close the position. Unless you want to have a short stop position and you're allowed to have a short stop position. If it's just a naked call, just buy back the call, close your position. If you have a covered call, then you have to figure out, do I love my stock and do I want to, not want to have it called away? If that's the case, then just close your short call position. But if you are okay to have your shares called away, don't do anything because it is covered. In that case, your short call, you will be assigned the call, shares will move out, money will come in, not much of a difference. But if you don't want to let the shares go, maybe you have some sentimental value for the shares. I mean, pick up whatever the reason is, I don't care. But maybe you want to hold it on long term because you're looking to capture the dividend. So in any case, if you want to hold the shares, then buy back the call, take a loss on the call option and hold the shares. So I think that's all I wanted to cover, everything around the assignment risk. But if you are having an ETF or a stock which gives dividend, you will be receiving, or you should receive, if your broker is doing the right job, you should receive a notice from broker saying, you have a short call position, there's an upcoming dividend, you may be at a risk of assignment. But now you know how to find whether you are at risk or not. Do you need to do anything, or you will fine, it is assignment, but there's too much extrinsic value left in it, so I don't have to worry about it. So I hope this would address and help you in going through the thought process when your broker sends you that email. Okay. All right, so let's look at some of the questions on that. You're welcome, Eric. So hopefully your query was answered. What is generally the qualification to negotiate lower commission fee? Size of account, frequency. I think everything. You can tell them that you already have a sizable account. Sometimes the threat to moving to a competitor, that works. So even if you don't increase your account size, you say, I'm going to move it to interactive brokers or XYZ. And that could help in reducing the commissions. You can tell them that my trade, the way I trade is, and that's what I used. So when I started with it, I told them I don't want these, base charges, because the way I want to trade is I'm trading small, but I want to trade a lot more. And the bigger commission is an impediment for me to, trade more. And frequency, that's the frequency of how much you trade. That is. So again, other thing is, if a stick of moving to another broker doesn't work, maybe a carrot could work. I have money in another brokerage account, but I don't want to move it here because your commissions are higher. If you could reduce the commissions, maybe I can move the money over to you, give them some incentive. But these are negotiable. Ramesh, the frequency of trade. Yeah, income you're generating for a broker, correct. Open interest is sum total of all the open calls for the strike price at the expiry date. That is correct, Sachin. That tells you how many contracts, call options are still open for that expiration for that strike price. Question from this. If I want to have the assignment, hold a short. Okay. Maybe Des, I'm not sure. Do you want me to discuss that in this call, or is that I can talk about it. That's a very specific question on a particular position, but let me first check if are there any other generic questions around the assignments or how to identify the risk of assignment or anything else on the topics that we have covered till today. Cool. All right, we get almost, at right on time. So good for the folks who have joined from East Coast. You don't have to. I feel good that we are able to close it at the right time. So if you want to drop off, feel free. I'll probably address some of the questions that I see that are coming up. Sachin says, an OTM call with very high open interest will be better than ITM call with low open interest. So I don't know what, Sachin, are you trying to do here? So I will look at, what is that I'm planning to do with that stock, right? So if I were to sell an option, do I want to give myself more room for error? Then I'll go and sell OTM. Now, I want to make sure that there is enough volume being traded on the strike price so that I can get a favorable pricing or a decent pricing. Okay, earnings play buy call. So buy call, again, buy call means then you have to be right on your outlook and the stock has to cooperate on the outlook. And it's a speculative play. Now, whether looking at the volume on that call option, can I determine whether the stock is going to go higher? Stock, probably no. It's a 50-50 chance. And I can share something with you right away. I took a speculative bet because I already earned enough on the ticker called Jumia Technologies, JMIA. I had some stocks and some short put positions, and I made some decent money because JMIA had a good run up recently. So let me just bring that up. And then this is why I should not listen to CNBCs. Then I hear on CNBC that on Jumia for 30th of call options, there were 17,000 call options trade happened. It means stock is going to go there because it's got earnings coming up, and the talking heads on CNBC, we are in it. I'm like, okay, I made money. Let me take a speculative bet. I also bought this, considering, and I marked it as a speculative bet, not as my earnings trade. That's not an earnings trade. That's a speculative bet, right? Now, what happened to Jumia? Now that option was trading at $1.15 or $1.20, 4 days ago. Today it is trading at 2 cents. You can see 2 cents. So looking at an open volume, it's a 50-50 chance. Sometimes that may turn out the stock has to cooperate. Sometimes it may not. So if I'm buying and doing those bets, I mark it as a speculative bet. So yeah, Sachin, you have to decide. You want to take a speculative bet because you are seeing a lot of call options over there? You may. But again, I don't think we can make a conclusive statement that tells us about the direction of the stock. If that's the case, then this would have already been gamed. All right. Any other questions? So if I were not to take the speculative bet, but I was still bullish, I would have sold a put on Jumia because that would have given me some buffer for error, and which is generally what I'll do. But like I said, I made some money in Jumia. I'm like, I don't mind, taking a lottery ticket. It's okay. So I took the lottery ticket. You're welcome, Miss. Yeah, good night to you folks. It's I appreciate you guys staying up for the session. That makes me, gives me motivation to come back. Cool. All right, no further questions. Then let's call it a day here, or let's call it an evening here for the folks on the West Coast. You guys have a wonderful evening, and I will see you on Saturday on our regular Saturday session. Goodbye.